The U.S. didn't add as many jobs as economists expected in August. The Labor Department says 142,000 jobs were added, slightly below economists' expectations of 160,000. And the unemployment rate dropped slightly from 4.3 to 4.2%. CBS News business analyst Jill Schlesinger joins me now in Studio 57. So it's my understanding from what economists are telling CBS News that this isn't necessarily bad news for the labor market, but it's maybe a sign of some softening.
Yeah, I mean, this is exactly what the Federal Reserve wants. They wanted the economy to cool down. They wanted the labor market to cool down. And we could not certainly sustain a market that was adding 500,000 jobs a month. We didn't want labor shortages. So a combination of maybe higher interest rates, new influx of people into the labor market, a lot of immigration in the last couple of years has really helped kind of put the labor market back in balance. And this is actually a good thing. Another part of this report that I thought was really good was that wages are rising on an annual basis faster than the inflation rate. It doesn't make up for the fact that prices went up so much, but it does help as workers start to see that the difference between what they're making and the cost of things really does start to narrow quite a bit.
But the numbers that we got today aren't necessarily enough for the Fed to say, you know what, things are slowing down so much that instead of 25 basis points, we're going to cut by 50 basis points.
Yeah, I mean, to be clear, this is an investor fantasy that I think that after the July report, so we were talking about August now. The July report, if you remember, in the very beginning of August, we got this massive sell-off. And people were like, oh, my God, there are fewer jobs. We're going into a recession. And you were telling us, whoa, 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 put the laptop away. Yeah, exactly. And by the way, 0.5 percentage point would have been maybe consistent if this particular report showed a much deeper deterioration. What's the Fed telling us? You know, we saw Jerome Powell speak just a few weeks ago in Jackson Hole, Wyoming. And you know what he said? He said, hey, inflation moving in the right direction. Labor market cooling from that red hot pace. We're happy. That really does argue for 0.25 percentage point at the September 18th decision. And you know what? They may not go by 0.25 percentage point every single meeting. Maybe they'll go by 0.5 point if the numbers get worse. Maybe they'll skip a meeting if things look better. So it is truly data dependent.
So I'm looking at the stocks on my phone, which I don't do every day for the record. I don't. I do this after we get these reports, and I need to see how it's reacting. Down slightly. What's the reaction?
Whatever. Who cares? I mean, honest to God, I could just pull my hair out with this. Well, okay. Yeah. Investors wanted something different. Who cares? Okay. By the way, oftentimes when I was a trader 100 years ago, okay, and oftentimes we say that the first reaction to data is often the wrong reaction. So let's be kind of smart about this. We're long-term investors. You're watching out there. You're thinking about what should you do. Do nothing. Just like you don't want to do anything when the market collapses. You don't want to do so much when the market's going up. Stick to your long-term game plan. These day-to-day gyrations, it's noise. Okay. And I'm happy to tell everybody that the noise that is happening today has nothing to do with you.
Great. Are we at the point where I can call you Dollar Jill yet?
It depends. Okay. I think so, but it has to have a lot of emphasis. You know, in other words, you cannot say the R after dollar. So let's try it again. Ready? You go now.
Dollar Jill, thank you.
Great to be with you.
All right.